We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of SRSrocco Report. Steve, thanks for joining me today. How are you?
Great, Tom. We see that the metals gold hit a new high today. This morning, silver was above 32.5. So it's a lot of interesting things happening in the market. Great to be here.
You know, it's kind of funny to finally be talking like that all the time, Steve. Like, it seems like every day, every other day, gold is trading at a new all-time high. Silver is trading at the highest point in something like 4 years, right?
Actually, it's if it gets above 32.5, 13 years.
13 years. So even more impressive, right?
Right.
And yet it doesn't seem like we have the interest that I think most of us would have expected in the industry. So, I want to start talking today about what makes a new floor for the silver price. And if that new floor ends up being, let's say long-term support for the price of silver now.
Well, I have a chart, and this is my analysis. People can disagree with me, and I haven't really found anybody, Tom, who can look at this chart. It's a 50-year chart of silver. It goes back to the 1970s, and as you can see, we get some tremendous spikes in the silver price. But after these spikes happen, the silver price comes back down to the cost of production. And this is similar with gold. It's the same thing with copper. Basically, the majority of the market is what something costs to produce it. And then when you get it to the market, there's some profits along the way, and that's necessary. And so when you look now from my analysis, my full cost, this isn't the all-in sustaining cost, but we're talking the top primary silver miners, even Fresnillo that produces 50 million ounces a year, it's now over 26. And people say, well, primary is only 30%. That's true. But when you look at some of the big base metal miners like KGM Palisade in Poland, they're a big copper miner. They produce 40 million ounces of silver a year. They're making a little bit of money. So they're not selling their silver for nothing. They all that money that they get from their revenue from silver, they need that to keep profitable. So we're seeing that it's a pretty good estimate that this is now becoming the new floor. And if you look at that chart, you could see it's a quarterly chart that it bounced right off of that 26 level. So this is kind of my foundational price. This is how, even though there's been a lot of volatility in the silver price, even though there's a lot of silver investment or inventories as well as gold inventories in the world, this has been a guideline for the floor in the gold and silver price. And so right now it's over $26.
Mm-hmm. Steve, I remember a while ago, you and I talked about the difference between like the AISC, the all-in sustaining cost,
right,
and how you actually see the cost to these miners. What else should be kind of taken into consideration when we're trying to understand what that all-in sustaining cost is?
Well, there's a lot of things. One of them is like there's taxes. Also, the all-in sustaining cost, what they've done is they have separated sustaining capital and developmental or expansionary. The problem is most of the miners are deducting their developmental or expansionary capital, so they don't include that in their cost, in their all-in sustaining cost. But that could be a significant amount. And we have it like Barrick or Newmont, we haven't seen them grow production, even though they're calling it expansionary or cost for capital. They should include all of it. So when you include all the cost, I go by the adjusted net income approach for my break even, and then I look at the free cash flow, and they tend to confirm each other. And so when you look at the total costs, and this is really not the total cost, Tom, because I'm not including a lot of share dilution And unfortunately, shareholders with diluted shares to continue bringing on more projects. That was what they had to resort to do. So the price to, or the cost to produce silver or gold is even higher than my total cost if we include share dilution.
Mm-hmm. Which, of course, you'd have to look at on a case-by-case basis per miner, right?
Yes, but I look at the top miners. I look at the top 7, 8 miners. Some, there could be some miners that are much cheaper, but no, when you look at all the miners all together, the top miners, it tends to be a good indicator of the price. And so even though there are some smaller miners that may be much lower cost, they don't produce that much gold. And so when you look at the majority of gold, I would think that's a pretty good estimate. And we keep seeing the price bounce off that cost of production. I didn't do that. The market did. So I think the market innately knows this.
So Steve, what other, let's say fundamentals are going to push this price of production, the cost of production higher?
Well, it's going to be energy and money printing. That's what's going to do it. Those two factors are likely going to continue to push the floor. Now, that's the floor. I think we are going to see much higher prices of the metals because they're money and they're store of value and collateral. That's the whole subject of another day, high quality collateral. And so when the market understands the problems we're having with energy, finance gets into trouble. And so we could see the metals prices go well above their cost of production as investors start transitioning into protecting wealth. So that's above and beyond energy and monetary inflation.
Mm-hmm. Yeah. So I just want to dig into that a little bit more if we could. You said money printing and energy. And I think just to flesh that out a little bit more, the money printing makes energy more expensive, but there's also dynamics within the energy market that make it more expensive too, right?
Yes, you have. If you can, when you print money, you increase the cost of the barrel of oil. Even though, if you didn't print money, the cost would be it would go up a little bit. But then there's a falling energy return on investment, and it just costs a lot more to produce unconventional oil than it did conventional that we were producing a lot of in the 30s, 40s, 50s, and 60s. I mean, there was no coincidence that the price of oil in the United States remained at $1.80 a barrel for the entire decade in the 1960s because there was so much conventional oil brought on from the Middle East. And so that's a one and done, and that's over. So now, yes, you've got very expensive unconventional oil that just costs more than conventional.
Mm-hmm. And then on the money printing side, obviously, that is just, dilution of purchasing power, which, in turn means inflation, which obviously in turn means the cost of anything, not just the energy needed, but also the equipment, all of the inputs into the equipment, the labor, all of that ends up going up.
Everything goes up, and we saw that tremendously after 2020. So yeah, the money printing and I call it the bond printing. The global bond printing kind of relates to the M2 money supply, and then of course there's a lot of off-balance sheet money. There's a lot of shadow banking money, euro dollar money that's out there too.
So Steve, when we look at the other side, not just the idea of the cost of production, but the demand side, why is it important to let's say really separate investment demand from industrial demand in silver?
Well, we don't have to separate it, but if we look at some numbers, if you go back to about 10 years ago, 2015, according to Metals Focus, if you add up all demand for silver minus investment demand, industrial demand, photography demand, silverware demand, jewelry demand is like 200 million ounces. When you add all that up, 2015, it was about 750 million ounces. Well, when you add up the global mine supply and also recycling, it was 1,050 million ounces. So back about 10 years ago, you had 300 million surplus. And then you had investment demand, whether it's in physical demand or ETF demand. Let's fast forward to the forecast that the Silver Institute or Metals Focus is putting out for 2014. They're suggesting all demand minus investment demand is going to basically take all supply. It's about 1 billion ounces of all investment, all industrial demand, jewelry demand, silverware, all that is 1 billion ounces. And the supply is only 1 billion ounces. So now investment demand comes in, and this is where it's been changing in the last several years. If you get a lot of investment demand, it starts eating into the inventories, wherever these inventories are. And we've been seeing that. And so this is now in a different ballpark, especially as green energy has been ramped up. So I think investment demand is going to be a major factor pushing the price of silver going forward.
Because that really operates, let's say, on the margins, right? The price is usually set on the margins because that's where that, let's say, unforeseen demand ends up coming from, right?
Yes, and there's just not a lot of silver out there. That can be a whole subject for a topic of another interview, but there's just not that much more silver compared to above ground gold. And so when you start getting to see a lot of we're seeing some, I mean, the SLV is up 27 million ounces since the beginning of the year. The inventories, it was falling even with the silver price going up, but that's changed. The GLD is the same way. So we're seeing more metal flow into the ETFs. And so, yeah, I definitely think as we get more demand, investment demand, on top of all this global demand for silver, we could see much higher prices.
Mm-hmm. So I want to kind of go back. We have a chart to show on how money printing ends up pushing, let's say, the price of production and really by proxy, this floor for silver up. And if you could, Steve, explain to us, why that ends up being the case over time.
Okay, yeah, this is a good chart because we do see the volatility, and silver tends to be more volatile than gold. And after the price of oil collapsed from $100, it remained at $100 from like 2011 to 2014, and it hit 30 something in 16. Well, the cost of production fell, and so the minimum, it was about $14, and you could see it was about like 16 to 19. That's where the cost of production, the minimum was. But then you'll notice it jumped to $20 after the pandemic shutdown. I mean, we're talking the Federal Reserve, the U.S. Treasury issued, I think, $7 trillion in several years of new treasuries, which is money supply. And this was global. So what happened was we see the cost of production jumped in 21 to $20. And then I looked at in 23, it turned out to be, it continued higher to like 22 and a half. And when I did the analysis for the second quarter, first half of 2024, I was surprised. Even Fresnillo, which produces 50 million ounces of silver a year, its costs continue to go up. And so now the top primary silver miners, it's about $26. Now, some were cheaper. Some newer mines have come on and they're lower, but that's not going to last either. So this is a very interesting dynamic that's taking place now. And so now, unless we get like $30 oil, which I don't think we'll get $30 oil, this is kind of the new floor for the silver price. Mm-hmm. And also, I also mentioned that due to what I believe we're going to see massive printing, because once you start, you can't stop, or you go into a depression you never get out of. So I think the central banks are going to be forced to do that. And that's why I think in the next 5 years, we could see the cost of production really move up to $33 to $35. And then again, it can go well above that due to investment demand.
Mm-hmm. And again, I think a lot of this is just due to that, basic measuring stick that is getting inflated away, or just the purchasing power of that measuring stick just keeps being destroyed, as you say, by this money printing, this expansion of debt and deficit spending, right?
Exactly. And, if you look at the circle, I call it a bullish monthly candlestick. Look how it just touched that 26 level. And so now, it's quite possible with this market melt up we're seeing, we could see silver approach that 35. I still think we can talk about this maybe a little bit later in the interview, but I still think we're going to get a market correction when the U.S. recession, global recession finally hits. So I don't think we can see higher highs, but I think we're going to see a correction. And when we get that correction, Tom, I think that's going to be the last time you'll be able to get silver or gold at that low price. I really do.
So, Steve, is it not just we're talking about the expansion of the money supply, the expansion of debt, really, but is the silver price also affected by the federal funds rate or the interest rate?
I did a post on this, and if you go back, it's interesting. You go back to 2007, the Fed started lowering rates in August. And as the Fed lowered rates, guess what? The Dow Jones continued higher to October, and so did the silver price. The Dow really didn't start to correct, Tom, until about December. And so 6 months later, we started getting the correction in the Dow. And even with the correction in the Dow, silver was going up. Now, it was going up with the oil price, because we have to remember the oil price went to 145 in early 2008. But we're not seeing that. We're seeing the metals kind of disconnect from oil, which is quite interesting. So I think by the Fed lowering rates, when you see higher rates, it tends to be not good for the metals, but that hasn't been the case. But when you start to see the Fed lower rates, it kind of gives the market this idea. We see these asset inflation. So I think that's going to continue. I really do. I think that will continue for several months. But the higher the gold and silver price go, we have to be prepared the more drastic that correction could be, because gold, my cost of production, Tom, is $1,900, maybe $1,875. At $2,700, and we hit $2,700 earlier today for gold, it's $800 above the cost of production. So I don't think this time is different yet. It will be. So I still think we're going to get a correction in the metals going forward.
I think that's an important point that I kind of want to underline going forward, as we're basically just entering this rate cutting cycle, is that this is typically, a correction ends up coming in the stock market after the first, a couple months after the first rate cuts, right?
Right. And when you look at the Fed charts, Federal Reserve charts, you could see this, that when about 6 months after they start cutting rates is when we head into a recession. Mm-hmm. And if people think, that we're not going to head into a recession, David Rosenberg, who I think is one of the better economists out there, he knew they were going to cut 50 basis points when the market was like kind of surprised, because the unemployment data is really bad. And I think he's correct that they're going to start revising this data lower. I think we're going to start, or higher. We're going to start seeing unemployment is going to be higher than what they originally thought. They're going to be revising it higher. And so I think we're heading into a weakness into the economy, and so then they're going to continue to lower rates, and that's going to be quite interesting, a development going forward, as I think the energy cliff goes back the other way as they start printing money. And so, yeah, I think we've got more volatility coming.
Mm-hmm. I spoke to Luke Groman earlier this week, and he said that we're basically not in a nominal sense going to have a recession, because the Fed can't, let's say that the Fed and the government can't allow that to happen because of the demand for debt and basically the mechanisms behind that. Do you think that the possibility exists that the Fed sees this and is going to do everything in their power to avoid that?
Well, you bring up an excellent point, and that's exactly what they did in 2008. They dropped the Fed funds rate all the way down to, what was it? They dropped it 500 basis points. The issue is, and guess what? The U.S. government added in 2 years, in 2008 and 9, or 9 and 10, they added $2 trillion in debt. This was a big number back then. Guess what? Lowering the interest rates, adding all that debt, it didn't stop the recession. You're seeing high delinquencies in credit cards, in car loans, even home mortgages delinquencies. And these are numbers that should be double the unemployment rate. Well, when the unemployment rate starts to really go up, then you're going to get much more delinquencies. So I don't think the Federal Reserve or the US government is going to be able to stop the business cycle. They may try to limit it, how low it gets. It may not get as bad as it got in 2009 and 10, but I still think we're going to get that. We're going to get that correction in the markets because the unemployment is just starting to pick up now.
Mm-hmm. Well, maybe that's just because they didn't act soon enough or with great enough magnitude last time, and this time will be different.
We'll see. We'll know if they're behind the eight ball, which I think they are, by the end of 2025, after the election, when whoever's in the White House, then you'll start to see it kick in the first half of 25, I think, or first quarter 25. You'll know that we're heading towards a recession if we start getting unemployment above 5%, in 2025.
And again, kind of reiterating that point, more money printing just means more inflation, which means that measuring stick in terms of real goods just keeps getting lower and lower and lower.
Yes, that is true. I think there'll be a bit of a lag effect, but that's what I always said. When we get into the energy cliff, which you start getting in a plateau of energy, the volatility on the way up and down for commodity prices and energy prices and goods, it's gonna be volatile. And so we had that huge inflation, 9%, right? And then it came all the way back down. Well, it'll go back up again, but that may take time for that to happen.
Mm-hmm. One of the other, let's say, pieces of trying to understand or get clues to where the prices for the metals are headed is always the commitment of traders' reports. This seems like something that is a little bit opaque, but kind of a clue in some ways to understand the positioning by the managed money funds. So are the COT reports a reliable way to understand demand as well?
I don't know if they're reliable for demand, but this is what I found. I like to keep it simple, stupid, Tom. When the commercial net short position in gold and silver get to a low, when they have a low amount, like almost, I think silver got to basically it was flat. It was a zero or a negative commercial net short position. You saw silver was at a low. So as the price of gold goes up and silver goes up, we see a larger and larger and larger commercial net short position, and that's business as usual. So I look at it, and last week was no different. We had a huge increase in the gold commercial net short position and silver. And so in 2011, it was different, Tom. We did not see, when the price of silver hit 50 in May 2011, we did not see the commercial net short position increase for like about 6-8 months since 2010, but we're seeing that now. So if we were going to see a $50 silver, we wouldn't have added 7,000 commercial net short positions. So that's what I look at. So I think when we get this market correction, even though the metals prices can go higher, we could see 28 gold, we could see 3,000 gold, and 35, 38 silver. We could see that, but when that correction comes, then it's going to be violent because it's so high above the cost of production. And I don't think this time is different. We'll talk about that, but I don't think this time is different yet. But that time is still coming.
So let's say looking out, let's say the next 5 to 10 years. Again, I think we really have to use clues. There's no solid data that we can really point to that shows us what's going to happen. But
right.
I think going back to some of the fundamentals to try to understand where the price is headed are very helpful in doing that. So when we think about global mine supply and output, what does that look like, going out into the future here?
We've had declines. It peaked about 900 million ounces in 2015, 16. And I think Metals Focus says it's going to decline a bit this year. Some other agencies, consultancy says it'll increase a bit in 2024. We are bringing on a few more projects, but it's about 70 million ounces less than it was, 830 million ounces plus or minus. So it's 70 million ounces less. Well, guess what, Tom? Since 2017, we've added Fresnillo and Mag Silver, added Juanicipio. We've added Los Gatos mine. We've SSR Mining added Chichilias mine. We've added the Keno Hill mine. We've added 50 million, 55 million ounces of new projects as of 2023. And production has still declined. This is the depletion. There have been a few mines, like there was the Tahoe mine, mine in Guatemala that they shut down. That's now owned by Pan American Silver, and they're trying to get that back up and running. So there's been some mines that have been shut off in even Peru. Even though with that, we're seeing depletion because there hasn't been a big enough or a large enough, high enough silver price to really bring on new projects. And so even Fresnillo is they're showing that their mines, besides Juanicipio, they're going to decline in the next several years. So I think we're going to be flat or slightly decline in the next 5 years. And so this is not good for demand that I think is going to increase considerably.
Well, I mean, that's exactly the other side of this equation that we need to consider as well, is what the demand picture ends up looking like.
Well, right now, the demand, according to the Silver Institute, I know there's different agencies out there, consultancies that have different data. But if you include physical demand, physical investment demand, it's 200 million ounces more than the supply this year. That's what it will be. And so that has to be made up from inventories. Now, we know some transparent inventories on the COMEX and the LBMA and the exchanges, and even in ETFs. But there is off-balance sheet that we don't know about. There is silver in China and elsewhere that we don't know about. So it seems to be feeding these deficits. But we have seen some big declines in inventories. So I think this is going to continue, Tom. I think we're going to see demand go, it could get to 1.2 billion, 1.3. If you really get ETF and silver physical demand really take off, there just isn't the available demand or supply. So it has to come from existing inventories, only at much higher prices.
Mm-hmm. Where is that supply, let's say that float, coming from, Steve? You know, every year it seems like we've been in deficit, and that hasn't really made the price readjust to try to drive more production, to try and account for that deficit. So where does that float or that marginal supply end up coming from?
Well, we have a chart. I'll show you where some of that supply came from. But again, there is transparent silver inventories that we know about, and there are off over the counter, or they're not transparent. These are privately held. Even governments may have silver we just don't know about. I don't think these are huge inventories. So I think part of that has come from that kind of inventory. But we do have some transparent inventories from the LBMA, which was a pretty good indicator of this deficit that we've seen in the last several years.
Mm-hmm. And you know, obviously the solar industry or the photovoltaic industry is one of the big pieces of demand. And I wanted to get your feeling on, you know, as silver moves up in price, does that end up forcing these manufacturers to try to replace it with other metals that aren't as expensive?
Well, there was a seminar in China in September. There was the China Solar PV and Chain Seminar. And it was found out that they have been doing some pretty good thrifting and efficiencies, because China produces almost 90% of all the solar cells and 80+% of the panels. So each quarter from this seminar that they have been doing about 4 to 5% efficiencies each quarter. So it looks like in 2024, it's going to be 10, 15% efficiencies just in this year. So even though we're going to see a high amount of silver consumed for solar this year, what's going to happen going forward, that's going to continue, even though it will remain elevated and strong. Some analysts are saying it's going to be double or could consume all of mine supply. I don't see that happening, but it's going to still remain very strong. And there's another equation that people need to take into consideration. China added so much solar last year to their grid. I think it was 270 gigawatts, Tom. This year, first half of 2024, 102 gigawatts. Do you know that I think is becoming disabling to their grid? Because according to Reuters, they stopped reporting their renewable energy utilization just in the beginning of 2024. They're probably shutting off more of the solar and wind because they've added so much of it, and it hasn't been done efficiently because a lot of the sun is in the where the deserts are in China, on the, let's say, the eastern part of China, but they're not using that electricity there, and so it's not really being added efficiently, even though they've dumped a lot of solar. This is going to be a problem going forward to continue to ramp this much solar. There are going to be some headwinds because it's going to be very difficult to really scale up solar in an exponential way. It's going to increase. But again, China is finally showing us they've got 16% solar and wind in their grid now. And that is destabilizing if it isn't done efficiently. And so I think we're not going to get a massive increase in solar. It'll continue to increase, but it's not going to increase in the way many analysts or several analysts think it's going to increase.
Mm-hmm. So just to, go over that a little bit more, Steve, is it because of the way that they're implementing and adding the solar to the grid that makes it inefficient and ineffective as part of their power generation? Or is it just, let's say, due to the nature or the intermittent nature of this type of power generation itself?
Yes, it's intermittent. Coal and nat gas, and especially nuclear. Nuclear can be, the utilization rate in the United States for nuclear is 95%. Mm-hmm. Those plants are running 95% of the time. Now get this, China's solar last year was 14% utilization, 14%. In the United States, we were 25%. That just goes to show you how much lower China's utilization rate of their solar is. And if they continue to add even more, that's going to drop more. And so the problem is the sun only comes on a certain time of the day. Well, at night, people need a lot of power. It doesn't work, so you need batteries or something. So you could get a huge spike in solar power, but you may not need it. Especially if you added a lot of this solar power to the grid, you may not need it at that point in time. So this is the problem. And lastly, even though Europe has added a lot of solar and wind, they use a lot of nat gas to generate power. So they have the ability to fluctuate because natural gas is a good balancing power. China, natural gas is only 3% of their generation. They don't have a lot of natural gas balancing power, and coal isn't really good at doing that. It can come up and down, coal-fired plants. So this is the problem going forward by really ramping up green energy. It's not really efficient, and the way it's being done now, adding that much solar to China, I think was very problematic, and I think they're starting to realize that.
Yeah, it's interesting to consider how it's implemented, not just that it's implemented. It's not just this silver bullet, if you will, for energy generation. And of course, I did a really interesting interview with Robert Bryce, an energy expert, and we talked all about the idea of destabilizing a grid and what the effects on energy cost end up being because of that. So for anybody that wants to check that out, that was, we run through a lot of that stuff. So you mentioned a couple times this difference in inventories of the LBMA and kind of the trend that we've seen that heading in. So has a lot of the metal been leaving the LBMA inventories and ended up getting taken up by the ETFs?
Yeah, well, we could see that right here prior to the 2020 pandemic shutdown. And, demand for metals, the fear. There was not only a lot of physical buying of metal, coins and bars, there was investors got into the ETFs. And we could see that right here. So what's interesting, like in 2019, when you look at the LBMA silver holdings, 67%, 2/3 was in the other category, and 33% was in ETFs. Then you had the pandemic shutdown. A lot of this silver is the SLV, but there are other European ETFs too, silver ETFs, but there's a good bit of the SLV is held in London. So we see that big increase in the SLV or the inventories in the gray line. But then look what happened in 2022. You see a waterfall decline in the inventories overall. And a lot of that was due to Indian buying. I think it was 9,200 metric tons in 2022. And then there was just a lot of buying. There was a lot of physical buying. And so that deficit was shown to take place right there. That's where it went. And so, but we see some did come out of the ETFs. But now it's totally flipped, Tom. It's 63% of the total inventories are ETFs and only 37% is in other. I think we're going to continue to see an increase in the ETFs as more investors, institutions start to move into the ETFs, and that other category will likely decline. So this is going to be an ongoing indication as these deficits, these annual deficits, as demand for investment continues to get stronger and stronger, it's going to have to come from inventories because that's the only place, because we don't have enough mine supply and scrap.
So Steve, kind of going back to something we were talking about a little bit earlier, is this idea of cost of production. Just kind of sitting here thinking about this, is there a way to kind of understand, let's say, the relative value of being undervalued by the market or even overvalued by the market, looking at these miners via, let's say, their cost of production? If they present a good opportunity to the market via their share price, by looking at their cost of production?
Well, we know this is the case because of two of the larger gold miners like Alamos Gold and Agnico Eagle, they have the lowest costs of the group I look at. And their stock price has been doing very well. Newmont and Barrick, they've gone up, but they haven't really performed as well compared to Agnico or Alamos Gold. And so it does make a difference. When you have a lower cost of production, you have more profits. And so that's shown as in dividends. And so the problem is the gold miners are doing so much better than the primary silver miners. Even though now there's been a good margin now because the silver price has hit 32. Mm-hmm. So you've got a $6 profit. If it's $26, that's your cost now. But the gold miners, they have an $800 profit. So, and the lower cost ones had even a higher profit margin. And so yes, when you see that lower cost, but there aren't many of those. Mm-hmm. And I think most of them are still in the higher cost or higher cost. And that's why we haven't seen, even though the GDX and the gold miners, it hasn't really performed that well because it's just so expensive. The capital, it's just so expensive to produce gold.
So it's almost like investing based on the gold to silver ratio, but it just gives us another kind of metric by which to measure the cost of these miners.
Yeah, when I go back to 2011 and I look at the high price of gold, it hit 1923, Tom, in 2011. Barrick and Newmont, their cost of production was like 1175. They had a $700 profit margin. It was a 64% margin at the peak, that peak day. Well, right now with $800, it's about a 42% profit margin, 44% profit margin. So yes, gold could go to 28, it could go to 3,000 because it went up to 1923 with a 64% profit margin. So but the thing is, in a year or two later, it came down. It came down. It came all the way down to 1,300. So I'm not saying that it's going to come down to 1,300, but the cost floor now is 1,900. So I think metals investors need to understand that dynamic can happen again, and I think it will.
Mm-hmm. You know, again, thinking about this measuring stick side of the equation, do you think that de-dollarization has really picked up steam, and do Asian central banks look to gold as really a neutral reserve asset?
I think we're seeing more of that in the background. The data, which we'll talk about in a minute, doesn't really prove of a massive de-dollarization, but it makes sense for other, especially the Eastern countries, to start doing more trade with themselves. And so we're seeing more central bank gold buying, and that is happening. And it's not really happening in a lot of Western banks. It's happening in the Eastern and Asian banks, central banks. So we are definitely seeing that, but I don't think we're seeing a massive de-dollarization happening currently. We are seeing some that will likely increase in the future, but it'll take time before the world. Do you know when we're de-dollarizing? When you're seeing massive demand for gold in all sectors, Tom. Do you know in the second quarter 2024, jewelry demand was down 20% because the price of gold went up. Central bank demand had declined from the quarter before. Even investment demand had declined. The biggest increase was over the counter. And we can talk about that. And so the thing is, when we are seeing real de-dollarization, you're going to get Americans buying gold. You're going to get a lot of people buying physical gold, a lot of people buying jewelry, because that's the way they invest in gold in India. But we're not quite seeing that yet. And so when we know we're heading into de-dollarization, when we get massive demand in all aspects of the gold market, and we're not seeing that yet.
Mm-hmm. Do you think that central banks are getting less price sensitive? You know, as the gold price is increasing, they just view it more and more as, you know, maybe almost like insurance, or you know, why do you think that they're getting less price sensitive?
I think sometimes they do, because a lot of the buying that central banks were doing, and we can talk about this a bit, depending on who you follow, what consultancy, IMF looks at official gold buying, and then like Metals Focus looks at unofficial. So there's been a lot of unofficial gold buying by central banks. So when you include that, they bought a lot more when gold was lower back. But now with the price going up, we see a decline in gold buying from central banks and unofficial buying of gold. So the thing is, I think like anything else, as costs go up, as money printing goes up, even though the price of gold is going up from 1,900 to 2,200, 2,400, they're still buying it because everything goes up. But I do think it'll be interesting to see what quarter three shows. I do think we're not going to see as much central bank buying. I do think when it really hits spikes, you may see a pullback until you get that correction. Mm-hmm. And lastly, the reason why there's a difference between IMF official gold buying and unofficial, because we need to understand, and this is my best analysis, and maybe someone can provide better analysis on this, but China produces a lot of gold. They produce most of the gold in the world. They don't export that gold. So if there isn't enough demand, the central bank will buy that gold. But it may not become official central bank buying. It's unofficial central bank buying, you see? And so Russia may be doing the same thing. And one thing I heard about Saudi Arabia was secretly buying a lot of gold. And they may have been. But they bought about $10 billion in gold in 2 years. Well, guess what? They've added 30 billion in US treasuries in the last year. Mm-hmm. So we don't see Saudi Arabia, if they were really de-dollarizing, why would they add 3 times the amount of treasuries compared to 1 time the amount of gold? We would see a decline in Saudi Arabia treasuries. So I think that's a very important dynamic that needs to be understood too.
Mm-hmm. Well, I totally agree that that's a really important point, Steve. Is Saudi Arabia the only ones that are buying that many treasuries, or is the rest of the world dumping treasuries? I think that would be a perfect sign that let's say these, in some ways, adversaries to the US would be getting rid of their treasuries because they don't want any form of the US dollar.
Well, the data doesn't show that. While China has definitely sold off some of its treasuries, I think it's like 52 billion in the last year. There's been kind of a cat and mouse game going on because there was a 53 billion increase in treasuries in Luxembourg. And I can tell you, Luxembourg isn't buying those treasuries. And so what's happening is, if we look at the gold buying, I think it was 70 billion in central bank gold buying for the last year. It's pretty good. Mm-hmm. There was 565 billion of foreign US Treasury buying. A lot of it was Western, but they're still buying US Treasuries. And so, and then, even though China has sold off some of its treasuries, some other countries have sold off some of their treasuries. I've heard that China has been investing in now US agency bonds, which are Fannie Freddie Mae bonds. And so even though they may be getting out of treasuries or hiding what their dollar denominated assets are, they're getting into other dollar denominated assets because the US government is now backstopping the entire real estate market. So if someone gets a loan, it's going to end up in Fannie Mae or Freddie Mac. So there's billions of dollars of agency bonds that look pretty good for foreign countries to own. So I don't think we're in this massive de-dollarization. The data doesn't show it yet. I gave you one example of Saudi Arabia. That will likely continue in the background and increase over time. But until we see massive demand in all sectors of gold, I don't see a huge de-dollarization taking place right now.
Mm-hmm. Steve, what does the copper price end up meaning to the world? And is this, a good proxy for really understanding where the economy of the world is headed?
Well, I wish I had a chart, the Dow Jones silver and copper chart, because right before the Fed lowered rates, copper was really underperforming silver and the Dow Jones. And there's a reason for that. If you look at this chart, this shows the top inventories from the LME, COMEX, and the Shanghai Futures Exchange. If you look at August, go all the way across, it's almost 600,000 metric tons. Now, if you go back August of 23, August of 22, it's 3 times. So what's happened in just the last several months, and you can see it's really built up since the beginning of January, especially the LME, the London Metal Exchange. Look how much theirs have increased. They're 320,000. What's happened, I think this is the key commodity. This is the industrial copper, is the king copper. When you see this kind of build in inventories, something's wrong, Tom. Mm-hmm. Now, even though we see a decline in inventories lately in China, well, according to the data, they cut back 13% inventories of copper in August. So it looks like a lot of that went to London. So the thing is, if this continues, even though we've had the Fed lower rates, and you get the big bounce up in the metals, and copper's gone up with silver, and the Dow Jones and the market's gone up, I still think the fundamentals are showing weakness here. So I even though we're getting higher prices in metals, I think if we continue to see these inventories increase, we're heading towards a global recession. And that's typically not good for metals prices and copper.
I know I've been told before, Steve, that a lot of copper trades end up happening outside of the exchanges. So again, I think this is an important, let's say, clue, but not necessarily completely conclusive all the time, because of the amount of copper that trades outside of the exchanges, right?
Well, that's true. And I would agree with you. That is definitely true. So the thing is, if that's the case, why would these inventories be increasing?
Yeah.
And so I do agree with you. It's difficult. I'm not a copper specialist, but in looking at what happened, you see copper and silver hit a high in May, and then they sold off, and then they bounced back up. Silver is now hit its high. Copper hasn't. Copper has not gone up it's like 450 or something, 455, 458. Its high was 511.
Mm-hmm.
So the thing is, it'll be interesting to see if these inventories continue to increase, and we've had a little bit more supply of copper come on. I really think it's telling us that something's wrong with China. I think China's in trouble, which is why they did the big stimulus package. I think China's in trouble. Mm-hmm. And so we're seeing that in these inventory numbers.
Mm-hmm. Steve, as you're explaining that, this kind of points back towards what you were saying about the energy cliff as well. As we move towards the energy cliff, you explained that these markets become far more volatile. So is that another, let's say, symptom of the energy cliff starting to maybe come into the equation?
Yeah, we saw the first thing happen. We saw the first energy cliff when conventional peaked in 2006. 2 years later, we hit $145 oil. Then we hit $100 for 3 years, Tom, and we started bringing on shale. And thank God, let me tell you, people need to realize, well, the dollar, we're printing a lot of dollars. We're going to print 2 trillion this year in deficits, right? So, but the rest of the world's doing the same thing. And guess what, though? At least we've got the energy to back it up, Tom. If you look at all the energy, all the oil, natural gas liquids, ethanol, refining gains, the U.S. is producing 22.5 million barrels a day of this stuff. The world is like 102, 103 million barrels. We're not quite a quarter. But if you go back to 2006 or 7, we're producing about 7 million barrels of this. It's grown 3 times. So we kind of have the energy to back this stuff up. Well, China's got to import. They're importing 14 million barrels a day of energy. So we need to put it into perspective. Yes, the dollar, we're printing a lot of dollars. China's printing a lot of yuan, and so we need to understand that as we hit this energy cliff, and we can add more production, I think we're going to be in a plateau, but we're never going to get that huge 13.5 million barrel a day increase from the U.S. shale oil and natural gas liquids. That's not going to happen again. There's no 2.0. So we may add a few million barrels a day. And so if you understand the amount of debt we're going to have to add to continue all this very leveraged finance, that's why I think we're going to see a lot of inflation coming. That's when you get the correction in the markets, things sell off, but then the printing starts back in again. And then you get shortages as the printing gets back up again. And then you start seeing the energy cliff prices go back up the other way, where you get to $85, $90, $100, $120 oil. That's the way it happens. It becomes very volatile.
So this really, some of these, let's say, shortages that we're going to start seeing, because energy is so, let's say, tied to GDP, a lot of these shortages end up kind of trying to be made up by debt issue.
Yeah, and the amount of debt we have added in the world, it's almost tripled in the last 20 years. So that to me is an indication that's trying to offset the falling energy return on investment of energy. Even though we're bringing on a lot more volume of it, of natural gas and of oil, liquids, petroleum liquids, the world is adding a lot of debt to offset this. And so they're going to continue to do that. And when it becomes very difficult to do that, that's when you get these volatile prices. And again, I think we're going to revisit 100 plus oil again. That's coming. And we're going to see much higher natural gas prices, especially. That's coming too. And so that's going to be driving the inflation.
And of course, you just kind of touched on this exponential debt growth over the last couple decades. And this chart that we have up on the screen right now shows us this.
Yeah, this is, I also have a chart. Up until recently, our cumulative deficits have mirrored the M2 money supply, but we can see how it's really moved up. And this is per decade. So we had what, 8.2, 8.3 trillion in deficits, which is M2 money supply. That's where it happens. In just the first 5 years, because I include 2020, it's right now it's 10.8 trillion. We're 2.6 trillion above the 2010 decade. And the next chart shows you my estimate if we continue on the same trend. Now, again, we just added, we'll be about 11 trillion in debt for 2024, because that was as of August. We have to add September, which I think will be over 150 billion. I think we'll add easily 7-8 trillion in the next 5 years. Easily. So this is becoming an exponential trend. If they don't do this, then the entire market starts to fall apart, because all the assets, pension plans, all this stuff really all the asset values start to fall apart. You go into a depression that you never really get out of. So this is a conundrum. This is a predicament. There's no solution to this. It's either print or die. And unfortunately, I think that they're going to have to print. And that's why we're going to see much higher inflation and much higher energy prices, as well as metal prices.
Steve, as we're discussing this, I had a discussion the other day with Richard Duncan that says that we should basically spend have very focused spending to try to facilitate growth and facilitate, kind of moving production and productive capacity back into the economy, into the domestic economy. Do you think that no matter what we end up kind of printing, and even if we really try to focus on growth and bringing production back domestically, do you think that the energy cliff ends up being far more consequential to a strategy like that than just being able to print our way through a problem like that?
Yes. There is you look in history, in ancient history, all this tends to follow a certain guideline, certain outline, and you can't go back. Once you reach a certain point up the trend, you can't go back and start over. Mm-hmm. You have the collapse of the Roman Empire. You can't go back and say, let's get a redo. And the issue is, when we had all the cheap energy, the United States won World War II due to the massive energy it had. Basically, that was it. And so now we had all this energy, but then as we peaked in energy in 1970 in oil, we started to offshore to make it cheaper to produce things like in Asia, Japan, and now China. To come back and do that in the United States, we've been getting a lot of immigrants come in. Now you've got a lot more people need to work. So then you're going to have people who are sit behind a computer like me now have to go back and do something physical. Mm-hmm. The issue is we don't have the energy to do that. We don't have the profitable energy to become more of a manufacturing. The cost would be too much higher. Our standard of living in the United States, for most people, I'm not talking about the poor, unfortunately, but for the middle class, they couldn't afford to go back to a manufacturing economy. We don't have the profitable energy to do that. It was a one-way street. I think it's a wise idea to do more of that. We just have to live a lower standard of living. People, we could do that on a lower standard of living. That's the only way for that to happen.
Which might be forced upon some people.
Well, you see, we've got two choices with an energy cliff scenario. You either manage peak energy, plateau energy, then declines. You say, okay, we're humans, we're smart, we're inventive. We can manage this. I don't think you can't grow it, and that's a whole interview for another day. How do you manage it? So either we can manage this, or it can be chaotic. And unfortunately, the way I look at what's happening in American politics, looking at what's happening worldwide, we don't have a good way of working things out together. So it looks like it's going to be chaotic, unfortunately. And that's unfortunately, that has been human nature. That's why you have empires collapse.
Mm-hmm. Steve, there's been some talk of balancing the budget. And I just want to get your take on if that's even possible and what the effect of actually balancing the budget would mean for the economy and the markets.
I looked, since 2017, the US has added 13 trillion deficits. The GDP has increased 10 trillion. You stop doing those deficit spending, and people think a lot of that money is going to regular people, whether it's efficient or not. In Medicare, it's income security. People are getting money and that money is being spent in the economy. You cut that off. It was, I think it's 8%. 2 trillion this year of deficits is 8% of our GDP. You cut that off. You just cut the GDP. And then you got to remember, when a nurse gets paid because of Medicare, she goes and gets her hair done. She buys this. Well, now you cut Medicare, that nurse may get laid off. It's going to be a compounding, cascading effect. So this is when any politician says they're going to balance the budget. If you're going to balance the budget, you're going to kill the economy. And unfortunately, then you start killing the energy too. So this is a very complicated predicament. It's not a problem. It's a predicament with no solution. So I really feel, because I think the governments are trying to just keep the lights on. While a lot of people think if they stop printing, we can go to a gold currency and then everything's going to be fine. No, I think you get into a depression that you never get out of, unfortunately. That's all due to the energy, Tom.
Mm-hmm. Steve, when we think about all of these ideas, obviously a big reason a lot of our listeners are here are because of gold and silver. But with the advent of Bitcoin, it has been touted as, let's say, digital gold. Do you think that saving in Bitcoin is the same thing as saving in gold and silver?
I don't. But that won't change people from investing or speculating in Bitcoin, and that's going to continue. The interesting thing about the Bitcoin market, and we could do a whole interview on this, is how the Bitcoin mining industry is functioning. The whole idea of getting into Bitcoin is to be decentralized and to protect your wealth, right? Protect your money. The Bitcoin mining industry is doing massive share dilution. They're printing money by destroying shareholder value in an obnoxious amount to produce Bitcoin. And guess what? They're going to have to do even more share dilution, because the top Bitcoin miners in the United States, which is Marathon, Riot Platforms, CleanSpark, they're not selling their Bitcoin. Do you know in the last 3 months, they've sold 3% of their Bitcoin supply? In the second quarter of 2024, the gold miners sold 97% of their gold. And guess what? The gold price continued higher. Can you imagine they've held on to 97% of their Bitcoin because the idea we're going to get that Bitcoin doubling. The hope is everybody in the Bitcoin industry, in the Bitcoin universe, is banking on that post-halving double. Well, I don't know if it's going to happen or not, but if it doesn't happen, you're going to see the collapse of the Bitcoin mining industry because they're not making any money. They're losing money hand over fist. And I've done a lot of research on that. And I think soon you're going to see shareholders start leaving, as I think a lot of these Bitcoin miners are heading to penny stock heaven. Now, if you do get a doubling of the Bitcoin price, it will allow the industry the Bitcoin mining industry to survive a bit longer. But the problem is, Tom, I like to keep it simple, stupid. You can't melt down a Bitcoin into something useful. It's a digital representation of an asset value. And that only functions if you have a very high functioning internet and system that allows Bitcoin to trade. People are more than welcome to invest and speculate in Bitcoin. I think the mid to long-term fundamentals for assets like digital assets, I would be worried that it's going to be difficult to be able to transact in that. Where gold and silver, you don't have to worry about. You don't need energy to sell a gold or silver. You do need energy to transact in Bitcoin. That's the only difference that I see in those asset values.
Well, Steve, I appreciate you walking us through all of these ideas today and giving us your viewpoint and especially your charts and your data on all of this. Is there anything that you'd like to leave our listeners with to consider before we wrap up here?
Yeah, I think the most misunderstood thing that gives an asset its value is energy in all forms and stages. And the market doesn't understand that. Why? Because most of them are in financial assets. And so collateral, I've mentioned this before, the most important collateral that most people use is their real estate. Well, the financial industry, it's U.S. Treasuries. Now think about this. A U.S. Treasury is an IOU, it's a debt. You can borrow, that is the foundation of the collateral system in the world, is the U.S. Treasury. It's a debt. I think when energy really gets into trouble, the market is going to have to re-understand what is real collateral, what is the foundation of collateral, and that's really gold and silver, because it's not a debt, it's not an energy debt. So I think this is the most important thing, and I'm going to be doing more updates on, is that energy is what gives an asset its value. And unfortunately, most assets are based on an energy debt. Gold and silver are based on an energy store value in that gold and silver coin. It's a totally different market that the market doesn't seem to understand. So that is going to be, I think, a very big realization in the future as investors are waking up to protect wealth.
Mm-hmm. I was going to say, as you're going through that explanation, it occurred to me that, the market hasn't had to value any of these assets with anything other than abundant energy. And if we do end up kind of going down the other side of this energy cliff, that completely changes and flips on its head that equation.
Well, when you see that a financial asset, like a stock, is based on earnings, right? Mm-hmm. Future earnings. So if assets are based on future, there's so many assets out there, they're 4 or 5 times the amount of energy we have. And that's current. As energy production peaks and starts to decline, these assets are overvalued. And so I think that is the realization. It's just that these financial assets are claims on future economic growth or future economic activity. Gold and silver got their value from past economic activity, and they hold that value in those bars and coins. It's a totally different fundamental that the market doesn't realize, Tom, because we assume that energy is going to grow infinitely forever. And that's not the case. And it's never been the case. We're just beginning to realize that now.
Mm-hmm. Excellent, Steve. Well, again, I really appreciate you walking us through all of these ideas. For anybody that doesn't already follow Steve, all of his stuff is available at SRSrocco Report, 2 C's, roccoreport.com, and of course on Twitter as well, SRSrocco Report. Steve, thanks so much for your time today.
Tom, thanks a million. Let's do it again in 6 months to see how things changed.
Absolutely. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.